Hello guys, here is one of the most important lessons about trading. If you want to become a successful trader or investor, then you must learn how to spot and trade a divergence like a pro. Divergences should be one of your most important tools because they signal momentum coming into the main trend or indicate a possible reversal when the trend is nearly over. You don't even have to learn all the concepts about trading. If you master the divergences with basic price action and support and resistance levels, you can easily trade stocks, forex or any other instruments you prefer. So by the end of this video, you'll learn the power of divergences, you'll learn how to spot them easily, and you'll also discover the best indicators you must use to trade divergences. Before we continue, if you are new to the channel and you find value or you learn something new, please consider subscribing and leave us a like to show your support. So, what is a divergence? Almost all technical indicators track the evolution of price movement, meaning that they lag price. That's why most of the oscillators used in technical analysis are lagging indicators. When the price of a stock moves upward, the indicator also moves upward. When the price moves downward, the indicator also moves downward. But sometimes, however, a visual discrepancy is seen between the price and the indicator. This visual discrepancy is known as a non-confirmation and is called a divergence. There are two types of divergences: regular divergences and hidden divergences. A regular divergence is characterized by higher high prices but lower indicator values during an uptrend, and lower low prices followed by higher indicator values during a downtrend. A regular divergence is considered a leading indicator because it can identify with good accuracy tops and bottoms. It also helps traders to sell near the top and buy near the bottom. In other words, a classic divergence signals a possible trend reversal. A regular divergence has two patterns. First is the regular bearish divergence. A regular bearish divergence appears during an uptrend when the price is making higher highs, but the indicator indicates a lower high. As you can observe in this chart, the price was in a strong bullish trend, with the price pushing for new highs. However, the indicator failed to record new highs, on the contrary, recording a lower high. That's a strong indication of market exhaustion and a possible sign of market reversal, or at least a short-term correction. And second, we have regular bullish divergence. A regular bullish divergence appears during a downtrend when the price is making lower lows, but the oscillator records higher lows. Again, when we analyze this chart, we see that the price plunged quite aggressively, with the price seeking for new lows. This move was not confirmed by the indicator, which failed to record new lows, on the contrary, recording higher lows. Thus, the regular bullish divergence suggests a possible market reversal or a short-term correction. Besides regular divergences, we also have hidden divergences. A hidden divergence is a visual non-confirmation characterized by higher lows of the price but lower indicator values during an uptrend, and lower highs of the price and higher indicator values during a downtrend. Hidden divergences signal continuation moves in the direction of the prevailing trend. So that's the main difference between the regular divergences and the hidden ones. The regular divergences indicate reversals, while hidden divergences indicate continuation. So remember this important rule. A hidden divergence has two patterns. First, we have the bullish hidden divergence. In a bullish hidden divergence, the oscillator makes lower lows, but the price makes either a higher low or a double bottom low. This type of pattern occurs mainly during upward corrections. Let's take a look at this example. The price was in a very strong upward trend and recorded an important correction. The price resumed its initial upward direction and recorded another pullback. As you can observe, the price failed to record new lows and closed higher than the previous downward swing. However, if we look at the oscillator, it recorded a lower low, thus forming a hidden divergence and signaling that a possible upward movement is on the cards. Then we have the bearish hidden divergence. In a bearish hidden divergence, the oscillator makes higher highs, but the price makes either lower highs or double bottom highs. This type of pattern appears mainly during downtrend corrections. In this example, after a strong uptrend, the recent price action indicated a downward momentum, with the price making lower highs. Despite the fact that the price was making lower highs, the oscillator recorded higher highs, thus forming a hidden divergence. Now let's see the best indicators you could use to identify divergences. The relative strength index is a powerful indicator and one of the most reliable oscillators when used correctly. A great use of the relative strength index is to search for divergences between the RSI and the price of the stock. Let's use the Tesla stock as an example, with the RSI added on the chart, and let's see what we find. Here is a regular divergence, and here is a hidden divergence. Another great indicator for divergence trading is the CCI. The Commodity Channel Index is an oscillator used in technical analysis in order to measure the variation of a stock's price from its statistical mean. There are two main methods used by traders to interpret the Commodity Channel Index: looking for divergences and as an overbought or oversold indicator. Let's analyze this Amazon chart. In this area, we have a regular divergence, and here is a hidden divergence. If you want to learn more about the CCI, go watch an in-depth video about this indicator here. Another useful tool for spotting divergences is the OBV. The on-balance volume is a momentum indicator that relates volume to price change. The OBV shows if the market volume is flowing into or out of a security or a stock. Divergences occur when the price movement is not confirmed by the OBV. I use the OBV mainly for regular divergences. In this example, we have the market making higher highs and higher lows, but the OBV signaling the end of the trend. Also, probably my favorite indicator for identifying divergences, the stochastic. The stochastic oscillator is a momentum indicator excellent at pinpointing divergences. On this chart, we have a regular divergence here and a hidden divergence here. I also use the money flow index for spotting divergences. This indicator measures the strength of money flowing in and out of a security or a stock. The money flow index is related to the relative strength index, but with a twist. While the RSI only incorporates price, the money flow also incorporates the volume. The money flow index is great at spotting divergences because it also has a big advantage. It incorporates the volume. In this example, we have a clear regular divergence and a hidden divergence here. Another good indicator for divergence trading is the Awesome Oscillator. The Awesome Oscillator compares the recent momentum with a momentum over a wider frame of reference. The indicator is plotted as a histogram and is used to confirm the trends and determine possible cycle turning points. If you want to learn more about the Awesome Oscillator, here is a great tutorial on how to trade with it. Also, the momentum indicator can also generate decent divergence signals. Here we have a regular divergence signaling the end of the trend, and here we have a hidden divergence indicating a continuation of the trend. And of course, finally, the MACD, probably the most used indicator for spotting divergences by traders, not by me personally. In my opinion, the MACD is one of the worst indicators, but you can find some divergence signals with it, the regular ones in particular, like the obvious signal on this chart. Now, here is an important tip. Divergences are more reliable when you are using higher time frames. A signal that is produced on the 4-hour chart or on the daily chart is more reliable than a signal produced on the 15-minute chart. A divergence is more reliable on higher time frames because the market doesn't move as fast and is easier to define trends. You'll see the pattern developing and you'll have time to make the correct decisions. So, if you learned something new and found value, please consider subscribing to our channel, share and like this video, as it will help us a lot in the future. Until next time.